something was buried in 3.5 million pages of documents. Something that has nothing to do with the famous names everyone is talking about. Something that connects Jeffrey Epstein's financial network to a silver market thesis that is playing out right now in 2026, 15 years after it was written. And almost nobody noticed it because everyone was searching for politicians and celebrities while the financial documents sat there waiting to be read. What I'm about to show you is not speculation. These are documents that were released by the United States Department of Justice as part of the Epstein Files Transparency Act. Public records, searchable, verifiable. And buried in those files is an email from May 2011 that lays out the exact playbook for a silver squeeze. The same mechanics we are watching unfold right now, the same supply deficit, the same delivery pressure, the same flush of weak hands followed by institutional accumulation. Except this thesis was written 15 years ago by someone in Epstein's financial orbit. And next to that email sits a JPMorgan portfolio statement showing millions of shares of silver mining stocks being purchased at the exact same time. Watch until the end, because when you see how the 2011 thesis maps onto the 2026 reality, when you understand who was discussing this strategy and when, you will never look at the current silver market the same way. This is not conspiracy theory. This is financial archaeology. And what it reveals is that the smartest money in the world has been planning this move for over a decade. Let me give you the context first because the timing matters. In November 2025, the Epstein Files Transparency Act became law. It required the Department of Justice to release all unclassified records related to Jeffrey Epstein and Ghislaine Maxwell. Since January 2026, over 3.5 million pages have been published. Emails, bank statements, wire transfers, FBI summaries, flight logs, portfolio statements. The entire world focused on the political implications, the famous names, the criminal connections. And that makes sense, given the severity of the crimes involved. But while everyone was searching for celebrity scandals, a different story was sitting in the financial documents, a story about silver, about market mechanics, about a squeeze thesis that was being developed and potentially acted upon at the highest levels of private wealth management in 2011. The same year, silver ran from around $18 to nearly $50 before crashing. The same year, CME raised margins 5 times to crush the rally. The same year that Wall Street said the silver bubble had popped and would never recover. And in the middle of all that chaos, someone in Epstein's network was writing detailed analysis about how a silver squeeze actually works and what conditions are required to execute it successfully. The email is dated May 27, 2011, according to reports analyzing the released files. It was allegedly sent by someone identified as Bernard to an email address associated with Jeffrey Epstein. The subject line reportedly read, "Power of Attorney Silver Centrope." 3 concepts in one subject line. Legal authority, silver, and what appears to be a reference to a financial entity or account. This was not casual correspondence. This was business communication between a financial manager and a client about account structure and investment strategy. The email allegedly explains that Bernard was leaving his position at a Swiss private bank, not a retail bank, a private bank, the kind that manages money for individuals whose net worth starts at 9 figures, ultra-high net worth clients, family offices, the kind of wealth that operates in a completely different universe than retail investors. And Bernard needed Epstein to sign a power of attorney to maintain control over accounts even after changing institutions. That level of embedded financial management suggests deep trust and long-term relationship. But here is where it gets interesting for anyone following silver markets. The email allegedly continues with Bernard stating that he had enclosed research on the silver market. And according to the reported content, he wrote that he was fully convinced a squeeze is possible if one can take delivery of 100% of the futures contracts. Read that again. A squeeze is possible if one can take delivery of 100% of the futures contracts. That is not a casual observation. That is a mechanical understanding of how commodity futures markets break. That is the exact thesis that the Hunt brothers attempted in 1980, that Reddit tried to execute in 2021, that sovereign nations are now implementing in 2026. And it was being discussed in Epstein's financial circle in 2011 with research attachments analyzing the COMEX position limit structure. Now let me explain why that sentence is so significant. In commodity futures markets, most contracts never result in physical delivery. Traders roll positions forward. They close for cash settlement. They use futures for price exposure without ever touching the actual metal. The system works because only 10% to 20% of contracts typically stand for delivery. But if someone starts taking delivery of 100% of contracts, if they demand physical settlement instead of rolling forward, the fractional reserve structure breaks. There are more paper claims than physical ounces. And when everyone asks for their metal simultaneously, the system cannot deliver. That forces a short squeeze. Prices explode as shorts scramble to source physical metal to cover positions. That is the mechanism. And Bernard allegedly identified it precisely in that 2011 email. He understood that physical delivery is the weapon, not future speculation, not ETF accumulation, physical delivery of the actual metal. And he was explaining this to someone who had access to enormous capital and connections to the highest levels of global finance. But the email did not stop there, according to reports. Bernard allegedly wrote that the squeeze caused by the 5 margin requirement increases only squeeze the weak hands. Think about what that means. In April and May of 2011, silver had run from $18 to nearly $50. The rally was parabolic. Retail investors were piling in, social media was buzzing. Then CME raised margin requirements 5 times in 9 days, 5 times, from around $5,000 per contract to over $21,000, an increase of more than 300%. And the price collapsed from $50 back to $32 in a matter of weeks. The entire financial media declared the silver bubble dead. Analysts said retail got destroyed. The narrative was that silver would go back to $15 and stay there. But Bernard allegedly saw it differently. He reportedly characterized the margin hikes as a flush of weak hands. Not a fundamental change, not a collapse of the investment thesis, just a mechanical liquidation of leveraged speculators who could not meet the new margin requirements. The weak hands got shaken out, but the fundamentals remained, the supply deficit remained, the industrial demand remained. Only the speculative positioning changed. And if you understand that distinction, you understand why someone would see opportunity in the aftermath rather than defeat. The reported email then makes specific predictions. Bernard allegedly stated that silver without undue speculation would end the year at $60 per ounce. He reportedly cited an inflation-adjusted value of $150. And he predicted the gold to silver ratio would fall from 40 to 1 down to under 20 to 1 within 36 months. Let me put those numbers in context. In May 2011, silver had just crashed from $50 to $32. Every mainstream analyst was calling it a bubble that popped. The consensus was bearish, retail was demoralized, and in that environment, Bernard was allegedly telling Epstein that the true value was $150 adjusted for inflation, that the ratio would compress dramatically, that silver would end the year at $60 even without speculation driving it. Those were not mainstream predictions. Those were contrarian calls based on fundamental analysis of supply, demand, monetary properties, and market mechanics. And whether those predictions proved accurate matters because it tells us whether the analysis was sound or just another speculative thesis that failed. So let me show you what actually happened to silver from 2011 to 2026. Silver did not hit $60 by the end of 2011. It actually declined further to around $2,700 by year end. The crash continued. The weak hands kept selling. The mainstream narrative declared victory. But then something happened over the following years. Silver did not go to $15 like the consensus predicted. It stabilized, it built a base, and it started climbing. By 2016, it was back above $18. By 2020, it hit $29. By 2024, it broke above $30. And in January 2026, silver reached an all-time high of $121. Even after the subsequent crash back to $74, silver is currently trading around $83. That is 159% higher than where it was 1 year ago. And if you adjust Bernard's inflation-adjusted target of $150 from 2011 forward to 2026 using cumulative inflation over 15 years, you get a target north of $220. Silver is at $83 right now. If the fundamental analysis was correct and the directional call has been proven right over time, silver is currently trading at roughly 1/3 of its inflation-adjusted fair value according to that 2011 thesis. That does not prove the thesis was perfect, but it proves it was not wrong. It was just early. And in markets, being early looks identical to being wrong until suddenly it does not. Now here is where the story takes a darker turn. And I need to be very careful with how I present this because it involves real criminal activity and real victims. But the financial connections are part of the public record now. Allegedly, alongside this email and their released documents is a JPMorgan portfolio statement. The account holder is listed as Ghislaine Maxwell. The document reportedly shows transactions from December 2010, just 5 months before the Silver Squeeze email was sent. And according to reports analyzing these documents, the statement shows purchases of First Majestic Silver Corp stock. First Majestic is not a small company. It is one of the premier pure-play silver mining operations in the world, publicly traded on major exchanges, and the reported purchases were not small. Allegedly 100,000 shares in late November, then 3 million shares in early December. If those numbers are accurate, that represents a significant position in a silver mining company being accumulated through a JPMorgan account in the same time frame that Epstein's financial advisor was preparing research on silver squeeze mechanics. Now, I want to be absolutely clear. I cannot verify these documents personally. I am relaying what has been reported about the DOJ releases, and I am not claiming any coordination between the email and the stock purchases. But the convergence of timing is notable. Silver squeeze thesis being developed, silver mining stocks being purchased, both happening in the same financial network, both documented in files that were never meant to be public. And here is where JPMorgan enters the story in a different capacity. In September 2020, JPMorgan paid $920 million in fines to regulators. The charges were for manipulating precious metals markets, specifically gold and silver. The scheme was called spoofing. JPMorgan traders would place thousands of fake orders they never intended to execute. The fake orders would trick other market participants into thinking there was massive buying or selling pressure. Prices would move based on the fake orders. Then JPMorgan would cancel the orders and profit from the price movement they artificially created. This was not a one-time incident. This went on for over 8 years. From 2008 through 2016, multiple traders were convicted. Some went to prison. The head of JPMorgan's precious metals trading desk was found guilty of racketeering, not securities fraud, racketeering, the same charge used against organized crime families. This is public record. Federal court documents, guilty verdicts, prison sentences. So we have a documented pattern where JPMorgan was actively manipulating silver prices downward through illegal trading practices for nearly a decade. And during that same period, accounts at JPMorgan were allegedly accumulating silver mining stocks. And Epstein's financial network was allegedly developing silver squeeze research. Again, I'm not claiming direct coordination. I'm pointing out the convergence of documented facts and reported timelines. Now let me show you something that will make your head spin. In 2011, the year of the email, JPMorgan reportedly held 0 ounces of physical silver in their own name. 0. But by 2017, just 6 years later, JPMorgan had accumulated over 133 million ounces of physical silver, according to public warehouse data. More than the Hunt brothers held when they tried to corner the market in 1980. The Hunt brothers owned so much silver that the government had to intervene. They changed the rules, created Silver Rule 7, forced liquidation, crashed the market. And JPMorgan quietly accumulated even more than that without anyone noticing until analysts started tracking warehouse movements years later. The same bank that was spoofing silver prices downward through fake orders was simultaneously accumulating the largest physical silver position in modern history. They were suppressing the price with one hand while buying with the other. That is not speculation. That is documented in COMEX warehouse reports that anyone can access. The question is whether they understood what Bernard allegedly wrote to Epstein in 2011. That physical delivery is the mechanism for a squeeze. That accumulating physical while prices are suppressed is the optimal strategy. And that once weak hands are flushed, strong hands can accumulate before the squeeze executes. Let me now connect this to what is happening right now in 2026. Because this is not just a historical curiosity. The thesis from that 2011 email is more relevant today than it was when it was allegedly written. Bernard's reported core argument was simple. Physical delivery is the key. In 2011, COMEX had enough registered inventory to cover most delivery requests, even if more contracts than usual stood for delivery. In 2026, that is no longer true. Registered inventory has collapsed from over 300 million ounces in 2020 down to 82 million today, a 73% decline. Meanwhile, open interest for March 2026 represents 429 million ounces of claims. That is a 5-to-1 ratio, 5 paper claims for every physical ounce available, and delivery rates have exploded. January 2026 saw delivery requests 7 times higher than historical averages. February hit a 98% delivery rate, the exact mechanism Bernard allegedly described. Taking physical delivery instead of rolling contracts forward is now happening at unprecedented scale, not because retail traders read an old email, because the fundamental conditions have evolved to make physical delivery the rational strategy for anyone who actually needs the metal. And here is what makes 2026 different from 2011. In 2011, the buyers trying to squeeze silver were retail traders and small hedge funds. They could be flushed out with margin hikes. Raise the requirements 300% and they cannot meet the calls. Force liquidation, crash the price, weak hands exit. In 2026, the buyers are different. China implemented export controls on silver in January 2026, classified it as a strategic material. Same category as rare earths, only 44 companies can export. The United States added silver to the official critical minerals list. Both superpowers are racing to secure supply from Latin American mining operations. These are not retail traders who panic when margins double. These are sovereign nations with unlimited capital and strategic objectives. They do not get margin called. They do not care about short-term volatility. They just take delivery. And they do not sell. That changes everything. The weak hands got flushed in January 2026 when silver crashed from $121 to $74. Leveraged speculators got wiped out. Open interest dropped from 176,000 contracts to 137,000. But the price recovered to $83. Why? Because the strong hands, the sovereign buyers, the industrial manufacturers who need the metal, they did not sell. They bought more, they took delivery, and the supply keeps draining. Now, let me walk through Bernard's alleged thesis point by point and show you how it maps to 2026 data. First, he allegedly said the squeeze requires physical delivery. Check. COMEX delivery notices are at record levels. January 7 times normal. February 98% delivery rate. Buyers are demanding metal instead of rolling forward. Second, he allegedly said margin hikes only flush weak hands. Check. Silver crashed 39% in one day after margins increased 36% in 4 days. But then it recovered to $83 within weeks. The weak hands sold at $74. The strong hands bought at $74. Open interest dropped, but physical delivery rates stayed elevated. Third, his thesis depends on supply deficit. In 2011, the deficit was small and mostly investment-driven. In 2026, we are in the fifth consecutive year of structural deficit. Over 800 million ounces consumed from stockpiles. Solar demand doubled. Electric vehicles need silver. AI data centers need silver. 5G infrastructure needs silver. None of these demand categories existed in 2011. The deficit is worse now. Much worse. Fourth, his inflation-adjusted value was $150 in 2011. Adjusted forward 15 years of cumulative inflation brings that to $220 or higher. Silver is at $83. If the analysis was sound, we are trading at 1/3 of fair value right now. And here is the part that should make everyone pay attention. In 2011, the squeeze failed. Silver crashed from $50 to $27. Retail got destroyed. The thesis looked wrong. But Bernard allegedly characterized the margin hikes as flushing weak hands, not disproving the thesis, just delaying execution. And he was right, because here we are 15 years later. Silver hit $121. Even after crashing to $74, it is still at $83. The fundamentals won. They just took longer than anyone expected. And the conditions to execute the squeeze are now better than they were in 2011. Inventory is lower, delivery pressure is higher, the buyers are stronger, sovereign nations cannot be flushed by margin hikes, industrial manufacturers cannot stop buying because their production depends on silver supply. The weak hands are gone. What remains is the kind of money that Bernard allegedly described. The kind that takes delivery and holds, the kind that understands physical is the weapon. Now let me address something that happened in January 2021 that ties directly to this thesis. 10 years after Bernard allegedly wrote that email, the Reddit community Wall Street Bets attempted a silver squeeze. They called it the silver squeeze. It trended worldwide. Millions of retail traders tried to buy physical silver and silver ETFs to force a short squeeze on COMEX. The movement got massive attention. Silver briefly spiked to around $30. But then it failed. The price crashed back down. Retail lost money. The mainstream media mocked them. And the silver squeeze was declared dead. Again. But here's what nobody noticed. Bernard's alleged email from 2011 said the squeeze requires taking delivery of 100% of the futures contracts. The Wall Street Bets crowd in 2021 was buying SLV, an ETF, paper silver, not physical delivery. They were buying unallocated claims through a fractional reserve structure. They did the exact opposite of what the thesis required. They tried to squeeze silver the wrong way. And they failed for the same reason the 2011 attempt failed. Weak hands using leverage and paper instead of strong hands taking physical delivery. The information about how to actually execute the squeeze was allegedly sitting in Epstein's emails the entire time, but the files had not been released yet. Nobody had read them. The Reddit crowd did not know about Bernard's thesis. They did not understand that physical delivery is the only mechanism that works. They thought buying an ETF was the same as owning metal. It is not, and they learned that lesson the expensive way. But in 2026, the buyers are not making that mistake. China is not buying SLV. They are taking physical delivery and implementing export controls to keep metal inside their borders. The United States is not accumulating paper claims. They are designating silver as a critical mineral and securing supply chains directly from mining operations. Central banks are not buying ETFs. They are taking allocated bars into sovereign vaults. Everyone has learned the lesson that Bernard allegedly articulated 15 years ago. Physical delivery is the weapon. Paper is the distraction. And the buyers executing the strategy now have unlimited capital and strategic time horizons. They are not trying to make a quick trade. They are securing a strategic resource that is critical to solar energy, electric vehicles, semiconductors, 5G networks, medical equipment, and military technology. The demand is structural. The supply is finite. And the paper market cannot deliver when everyone asks for metal simultaneously. Now, let me show you why this matters for anyone holding silver right now. The thesis has not changed since 2011. It has only gotten stronger. The mechanism is still the same. Physical delivery breaks the fractional reserve. The fundamentals are better now than they were then. Deficit is larger. Inventory is lower. Buyers are stronger. The pattern is identical. Weak hands get flushed through margin hikes. Then strong hands accumulate at suppressed prices. We just watched it happen. On another $21 to $74 flush, then recovery to $83. Leveraged speculators are gone. Sovereign buyers and industrial manufacturers remain. The only thing that changed from 2011 to 2026 is scale. In 2011, it was private wealth networks allegedly discussing the strategy. In 2026, it is national governments executing it. In 2011, the squeeze failed because margin hikes flushed retail traders who could not meet the calls. In 2026, the buyers are sovereigns who do not get margin called. The playbook is the same, but the players are infinitely more powerful. And here is what the flow data shows happening right now. SLV, the largest silver ETF, saw $2.4 billion in outflows last week. Year-to-date outflows total $1.3 billion, despite silver being up 65%. Institutions are exiting paper. But where's the money going? PSLV, Sprott Physical Silver Trust, just doubled their capital program from $1 billion to $2 billion. Allocated physical trusts are seeing inflows while unallocated ETFs see outflows. Smart money is distinguishing between paper claims and physical metal. They are moving from fractional reserve structures to full reserve allocated storage. They learned the lesson. Physical is real. Paper is a claim that might not be honored when everyone asks for delivery. The divergence between SLV outflows and PSLV capital raising is showing you in real time what institutions believe. They believe the ETF structure will break. They believe COMEX will face a delivery failure. They believe physical is the only position that survives the squeeze. And they are positioning now before it becomes obvious to everyone else. Let me make something very clear, because I need you to understand the limitations of what I am showing you. I cannot personally verify the Bernard email. I have not seen the original document. I'm relaying what has been reported about the DOJ file releases. I cannot verify the Maxwell JPMorgan statement. I have not accessed those records directly. What I can verify is that the Epstein files were released, that JPMorgan did pay $920 million for precious metals manipulation, that JPMorgan did accumulate 133 million ounces by 2017, that China did implement export controls in January 2026, that the United States did classify silver as critical, that COMEX inventory did drop 73%, that delivery rates did spike to records. All of those facts are verifiable through public sources. The question is whether the convergence of the alleged 2011 email and the 2026 reality is coincidence or pattern. Whether the thesis allegedly discussed in Epstein's network is the same thesis now being executed by sovereigns. And whether understanding that thesis gives us insight into what happens next. Here is what I think the pattern reveals. The ultra-wealthy, the private wealth networks, the family offices operating at the highest levels of global finance, they were studying silver market mechanics long before retail investors discovered Wall Street bets. They understood physical delivery is the leverage point. They understood supply deficits create pricing power. They understood that weak hands can be flushed, but fundamentals persist. And whether through coordination or convergence, the strategy allegedly outlined in 2011 is now being executed in 2026 at sovereign scale. The thesis did not change. The timeline just extended, and the players got bigger. In 2011, it was allegedly discussed in private banking channels. In 2026, it is implemented through export controls and critical mineral designations. Same mechanics, different execution layer. And if that thesis was correct about the fundamentals, if $150 inflation adjusted to 2011 becomes $220 adjusted to 2026, then silver at $83 represents a massive disconnect between paper price and fundamental value. That disconnect will close. The only question is how violently and how fast. So here is my conclusion. I cannot tell you that Epstein's network coordinated a silver squeeze. I cannot prove direct connections between the email, the stock purchases, and the JPMorgan manipulation. What I can tell you is that the thesis allegedly outlined in that 2011 email, whether it came from Bernard or anyone else, is technically sound. Physical delivery does break fractional reserve commodity markets. Supply deficits do create pricing pressure. Margin hikes do flush weak hands without changing fundamentals. And strong hands do accumulate after weak hands exit. Those are not conspiracies. Those are market mechanics. And they are playing out right now in 2026 exactly as that thesis allegedly predicted. The conditions are met. The players are positioned. The inventory is drained. The delivery pressure is building. And March 1st notice day is coming in late February. If you want to verify anything I said, search for Epstein files, silver. Look for document reference FA01165 for the alleged email. Look for FA005020542 for the alleged portfolio statement. I cannot guarantee you will find them or that they say what has been reported, but if they exist and are searchable in the DOJ library, you can verify independently. Do not trust me. Verify the data. That is how this works. And if the convergence is real, if the thesis is sound, if the 2026 conditions match the 2011 analysis, then you have a decision to make about whether you believe paper promises or physical metal will win when the system breaks.